All right, what's going on, you guys? In this video, I'm going to explain to you guys what liquidity is, full breakdown. Make sure you guys fully understand this and what's behind it. So I made a slideshow for you guys. I hope you guys enjoy. There is 10 slides in this slideshow, and yeah, we're just going to get into it, and I'm going to make sure that you guys can understand this concept. All right, so we got what is liquidity by Sin Trades. Myself, I made this. I'm going to show you guys what this is and how to use it. All right, so we're going to go ahead and click to go to the next slide. So it says, in order to understand liquidity, you have to understand where it comes from. All right, so liquidity is just a terminology sense or a word that people use to describe something else. All right, so there is a root of liquidity, and the root of it is orders. All right, so there wouldn't be candlesticks or price action or anything of the sort if it wasn't for market and limit orders. All right, so we have market and limit orders, which create liquidity, and I'm going to go ahead and tell you guys what that is right now. So a market order means to place an immediate order at the market's current price. So for example, right, like if you went to a store and you found a Kit Kat, the Kit Kat is $2.50. You want to buy it at that price right now. So that Kit Kat is yours. So that would be your immediate market order in a sense. And for a limit order, it's placing a buy or a sell order at a designated area. So let's just say you had a Kit Kat that was $2.50, but you wanted to wait until it was on sale at $2 and then you buy it. That would be considered a limit order in a sense. You guys see what I'm saying? So liquidity is going to be the general order flow between immediate market orders and set limit orders. So price will move to the upside or to the downside, which means people are either taking immediate market orders and buying in at that area, or limit orders are being hit and people are getting sent into trades at that specific designed area, which causes the market to move, and it causes these candlesticks and it causes price action. So there's general types of liquidity, and I went ahead and wrote them down for you guys. I'm going to explain each of these three boxes here. The first one we have here is called a balanced market. So price action generally will move within a range showing a basically agreement between buyers and sellers. All right, so there's going to be an agreement between buyers and sellers in a high amount of transactions, which causes basically consolidation or a range. I'm going to show you guys an example, of course, but we have consolidation or a range, which causes just a balanced market, which is not good to be trading in because there's no general movement, there's no imbalance or difference between buyers and sellers, which just causes consolidation. So the next box we have here is a imbalanced market, and it's the result of one side being stronger than the other in terms of market and limit orders. So remember guys, liquidity is generally formed when there is market and limit orders by buyers or sellers in the market. So when price moves to push to one of these areas, buyers or sellers can be stronger based on the size of these orders. All right, so at key levels of interest, for example, if we're on the daily time frame and there's a very strong high or low, there's going to be a lot of liquidity and a lot of push at that area, and you want to make sure that there is proof that buyers or sellers are pushing and stepping in at that area. So for an imbalanced market, it is the difference between the market and limit orders of the buyers and the sellers. So we can be at a key area where price is stronger to the upside or to the downside, and these buyers or sellers can end up overpowering one another, which causes the imbalances. And the imbalances are what we as traders are looking to trade, because this is the moment where price is going to do a strong movement to either the upside or the downside. All right, so these imbalances or differences between buyers and sellers can happen because of news events or key levels of interest. So make sure that when you're trading at a very key area, a strong area where buyers or sellers could potentially step in. And you also want to make sure that there is confirmation or proof that buy and sell orders are being filled at that specific area you want to take your entry. Price likes to change from balance to imbalance. So there's going to be times where buyers and sellers agree with each other, which causes a ranging market where a bunch of transactions are filled. But at some point, the buyers or sellers are going to disagree, which causes the rapid movement to either the upside or the downside. And this disagreement can be caused by news events or just general economic standpoints, whatever the case may be. It can cause a disagreement, which causes the liquidity to one side or another. And then we have the third box here, which says an erratic market, which can generally happen when there is a very strong news events, for example, like tariffs or anything of the case. This can cause panic and fear within the market and limit orders or buyers and sellers in the market, which can cause a lot of rapid movement. And generally speaking, as a trader, you don't want to be a part of that, because that can cause you to get your positions liquidated, or you can get stopped out, which can cause you to lose money due to the rapid movement to the upside or the downside. So we want to make sure that we're trading imbalances, and we want to make sure that it aligns with the higher time frame and the general trend. The difference in volume from buyers and sellers are determined by the position sizes and the general market structure. So I'm going to show you guys an example. But if we have a general market structure, for example, a bullish uptrend or a bearish downtrend, there's going to be a difference in volume between the buyers and sellers, and the general position sizes will show you how strong this trend is going to be. So I'm going to show you guys an example right now. So in this example here, we have a general bullish uptrend where buyers are overpowering the sellers in this area, and we can see that price sweeps the liquidity of the recent orders before continuing higher and reaching the swing high as our target point. So the first thing we can notice is that the general trend is bullish in this example, and we have this point of liquidity, which would be considered our point of interest, and our target, which would be the swing high. So a question you could potentially be asking yourself is, how is this right here a liquidity sweep? Well, we had this bullish upwards movement right here, which shows that buyers took positions, and these orders caused the market to push higher. When these buy positions are placed, these orders have stop losses, and there is also going to be limit and market orders presented under this low where price action did not go to until price swept the liquidity right here. So we can also think of a liquidity sweep as a order sweep, because we have these buy side orders, which causes bullish candlesticks, and price will sweep to the downward side to fill the stop loss orders and fill the market and limit orders presented under this swing low before building enough momentum to continue the general trend, which is bullish. So what we need to do when price sweeps liquidity is make sure that there is proof that price is pushing upwards from this standpoint, and we also need to have a target area that is probable for price to hit. So in order to understand liquidity, you also need to understand what market manipulation is. So I wrote down here, market insider positions will sometimes fill in large orders to hit limit orders and stop losses of retail traders, causing the market to move rapidly. The rapid movement caused by the large orders, market or limit, is considered manipulation. And you want to ensure that your trades are not based off of manipulation, because the manipulation comes with rapid volatility, and that rapid volatility could hit your stop loss and generally make you lose money. All right. So you want to ensure that your trades are not based off of manipulation, and you want to make sure that your trades follow a general trend, either bullish or bearish. So one of the key pieces of information I believe you should get from this video is that there's going to be specific times where price is showing liquidity, but it's not going to be acceptable to take a trade or take a entry at that area. So this next slideshow here says, what is acceptable liquidity? And I went ahead and gave you guys two situations to hopefully broaden your knowledge on liquidity and how it works. So the first situation here says, the trader is trading the Asia session at 8 p.m. Eastern Standard Time, where there are few participants in the market. So trading in this current state means that higher quality setups will hold less power and have a stronger chance of failing, because price will be in a generally more balanced state, and there won't be any volume difference between buyers and sellers, which can cause manipulation to both sides. And then there's the second situation, which says the trader is trading the London kill zone session at 10 in the morning, where there are many participants in the market. So either way, in both standpoints, you need to make sure that your entry point is at a key area where there is a chance that you can get out of the market in a negative standpoint. But in situation 2, since there's more liquidity or movement, price has a stronger chance of following a general trend and showing bigger moves behind confluences rather than in situation 1. So now you should understand that the higher the liquidity or orders there are going to be in the market, the stronger the moves are going to be. And either buyers are going to overpower sellers or sellers are going to overpower buyers through market and limit orders, which causes imbalance. And imbalance is what we as traders are trying to trade to take profit, all right? And now we're getting close to the end of this video, so I want to make sure you guys have some general takeaways that you can bring with you as you continue your trading journey. So the first general takeaway here is liquidity is the fluctuation between buy and sell, market and limit orders intraday. So always keep in mind that there wouldn't be any candlesticks if there wasn't any liquidity, and the more orders we have, the more liquidity there's going to be and the stronger moves we will get. Apparently I can't type, but it's all good. The second takeaway says one side will overpower another between buyers and sellers, which creates imbalance. And these imbalances are going to be rapid moves. We want to make sure that they follow the general trend so we can take entries and target specific areas where price reacted to. The third takeaway here says insider positions and strong news events can manipulate the market, and be careful, which is very true. You guys need to make sure that when these things are happening, such as news events or tariffs or anything of the sort, make sure you're being very careful. And if you want to trade these positions, then make sure that you're trading a smaller contract or unit size so you have a bigger take profit and stop loss to deal with, all right? So you need to make sure that you're either trading a very small position, which gives you breathing room in between your stop loss and take profit, or you're just not trading when there are strong news events or manipulative markets, and just making sure that your account stays safe so you don't lose money and you don't have to go through a bunch of losses consecutively. And the final takeaway here says the time that you trade affects the quality and the probability of your setup. So if you're trading the Asia session at 8 p.m., it's not going to be as active as the London session at 10 in the morning, where there's going to be a lot more participants. And that's basically all I have for you guys regarding liquidity. I hope you guys enjoyed this, and if you guys have any questions, feel free to ask me on any platform. I will make sure to get you guys right. And in addition, if you guys check syntrades.com, there's going to be a lot of resources for you guys, like an ebook, a 400-page ICT book, mentorship, anything of the sort. If you guys are interested, just make sure to send me a message or email me, and I will make sure to reply to you and get to you as soon as possible. Thank you guys for watching, and enjoy the rest of your day.